Welcome to Dumbed Down Dollars, where complicated money finally makes sense. No jargon, no nonsense, just money explained simply. You're holding money right now, maybe in your pocket, maybe just numbers on a screen. It feels solid, earned, real. But most of that money was never printed, never mined, never saved by someone else before you. It was created the moment somebody went into debt. And if that sounds backwards, good, it should. The story of where money comes from isn't really about printing presses. It's about loans, promises, and a system that only works if debt keeps growing. Let's start with what almost everyone believes. You work, you get paid. Businesses sell things. The government prints cash. Money moves around. That story feels right because you see the movement. You don't see the creation. Imagine you walk into a bank for a home loan. You ask for 10 lakh. You sign papers. The bank approves. Now pause. What just happened? Most people picture a vault, stacks of notes, your 10 lakh taken from someone else's savings and handed to you. That's not what happens. When a bank approves a loan, it creates a deposit in your account. Before the loan, your balance might be close to zero. After the loan, it shows 10 lakh. That money did not exist in the money supply minutes earlier. No truck arrived, no pile of cash moved. A number was typed into a system. New money. This is not a metaphor. This is how modern banking works. You spend that money. You pay the builder. The builder pays workers. Workers buy food. The money spreads through the economy. It looks like ordinary circulation, but its origin point is debt. The birth certificate of most money is a loan contract. Now, zoom out. Governments do print some cash. Central banks do create reserves. But the majority of the money people actually use, the balances in bank accounts, comes from commercial banks making loans. Physical cash is a small slice. Bank deposits are the giant part, and deposits grow when loans grow. This matters because it flips the story. We're told banks are middlemen, savers on one side, borrowers on the other. In reality, banks are closer to money factories with a rulebook. They can't create infinite money. They're limited by regulations, capital requirements, risk, and whether borrowers can realistically repay. But within those limits, lending expands the money supply. So when you hear credit growth, you're also hearing money growth. Here's the strange loop. You borrow to buy a house. The bank creates money. You now owe the bank the loan plus interest. That interest wasn't created when the loan was issued. Only the principal was. So where does the interest come from? From the wider economy, from income people earn, from other loans, from more money being created somewhere else. The system relies on continuous lending, so there's enough money circulating for people to service old debts with interest. It's like an escalator. As long as it's moving upward, most people can step off safely. If it slows sharply, people stumble. This is why lending booms feel good. House prices rise, businesses expand, jobs grow. There's more money in pockets because there are more loans in the system. Credit expands, output rises, asset prices inflate. People call it growth. But there's a tough question underneath. Growth of what? Production or just debt? Often it's both, but the fuel underneath is borrowing. Now picture the opposite. Banks get nervous. Maybe the economy looks shaky. Maybe asset prices already seem too high. They tighten lending. Fewer loans are approved. Old loans are still being repaid. Money is quietly disappearing. When you repay a loan, the bank reduces your deposit and reduces the loan on its books. The money that was created when the loan was issued is effectively destroyed. Loans create money. Loan repayments erase money. So if new lending slows while repayments continue, the money supply can stagnate or shrink. Less money chasing goods. Businesses feel the squeeze. Layoffs start. People call it a recession. Same system, different phase. This is why central banks obsess over credit conditions. It's not just about interest rates in theory. It's about whether the private banking system is creating enough new money through lending to keep the machine running. Now here's the irony. People say we need to reduce debt. And at the individual level, that makes sense. Less personal debt means less stress. But at the system level, if everyone suddenly tried to pay down debt and stop borrowing, money creation would collapse, spending would fall, incomes would drop, paying down debt would become even harder. What's safe for one person can be dangerous for the whole system. Look at total debt over decades. Governments, companies, households. The line almost never goes down for long. It looks reckless. It's also structural, because in a system where money is mostly created as debt, shrinking total debt means shrinking money. Now compare hype versus reality. Hype says money is backed by gold, or productivity, or the strength of the economy. Reality is more mechanical. Money is largely backed by borrowers' promises to repay, plus the legal system that enforces those promises. Hype says the banks lend out your deposits. Reality is closer to loans creating deposits and the banking system sorting out reserves and liquidity afterwards. Hype says the system is like a big piggy bank. Reality is closer to a network of balance sheets expanding and contracting with credit. This doesn't make money fake. It makes it different from the story most of us grew up with. Money today is mostly credit, a claim, a promise recorded in a ledger. That promise works because we all accept it. Employers pay you in it. Stores accept it. Taxes are paid with it. The legal system stands behind it. But the engine that produces most of those claims is lending. And lending isn't neutral. Banks prefer to lend against assets that can rise in value. Houses, commercial property, financial assets. That's why so much newly created money flows into asset markets. Asset prices inflate faster than wages. People feel richer on paper. New buyers feel locked out. Inequality widens. More credit leads to more money. More money pushes asset prices higher. Higher prices allow more borrowing against those assets. A feedback loop. Until something breaks confidence. Then the loop can run in reverse. Zoom out further. This system is relatively new in historical terms. Gold coins didn't require someone else to be in debt for them to exist. Modern bank money does. That's why total debt levels today are enormous compared to centuries past. Not because people are irresponsible, but because the monetary system itself is intertwined with credit expansion. So when you hear the economy needs growth, part of what that often means in practice is that the system needs continued credit creation. That's the design. The uncomfortable part isn't that money is created from nothing in a magical sense. It's that it's created from balance sheets, from obligations, from future income being pulled into the present. We live today partly on tomorrow's promises. Most days, that works. People earn, businesses produce, loans get serviced, new loans replace old ones. But the system is always balancing between too much credit, which can inflate bubbles, and too little credit, which can choke the flow of money. A system built on expanding credit has limits somewhere: political, economic, psychological. So where does money actually come from? Not from a vault, not mainly from printing presses. It comes from a decision inside a bank. Yes, this borrower is creditworthy. A number appears. A new deposit is born. The money supply expands. And every time that happens, the future is pulled a little closer into the present. The real question isn't just how money is created. It's how long a system built on ever-growing promises can keep those promises feeling solid. Now you understand money a little better. If you like learning the simple way, hit subscribe. More money made simple every week.